name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A second consecutive indecisive spinning top yesterday, and a continuing respite from the recent bullishness. The overhead resistance from the lesser fibs at Fibonacci levels at 118.87 and 118.97 still hampers any significant attempt higher. Oh, they'll still let you go through them during the day, but try and close over them, well, that's a different story. Overall, this is still a move up and away from the upper trend line, currently 117.47, of the descending wedge pattern, which you've seen recently over the last, couple of months. We're still approaching, slowly admittedly, target X on the upside, the potential target for the descending wedge pattern, and that's in the 119.30 area. The only issue has been, as I've already mentioned, the cap on the rise by these two lesser Fibonacci levels. Now beyond target X we have the continuation lower diamond trend line, currently 119.42, from the December 2019 to May 2020 diamond pattern. However, I suspect that may not be that strong a resistance, and we may well have to rely on the 119.75 area, which contains the 50% Fibonacci line of the November 2020 to January 2021 move. And most interestingly, the dead cross of the short stroke medium moving average, currently 119.63, down through the medium moving average, currently 119.72. Now so far today, well, it didn't look that much, but we had a small move higher, and yet again the two lesser Fibonacci levels at 118.87 and 118.97 have halted the move. So the market has now reverted back down a little below the June 2018 high at 118.51 that had previously sustained the recent move higher. Now if we see more of this, then we may have to start looking on the downside, however unsustainable the topside cap may seem to be. Cable, aka sterling against the US dollar. A small bullish engulfing pattern, if only just yesterday. It was an attempt to tackle the lighter of the two overhead resistances, the medium flatlining moving average, currently at 139.21. The market penetrated it, but turned back down shy of testing the more potent overhead short medium moving average, currently at 139.47, before closing back down under both of them. Below, well, some distance now, we have the interesting and gently rising long moving average, currently 137.56. Now so far today, a fresh attempt up over the medium moving average, and what looks like a more serious attempt at the short medium moving average. The continuation of the previous 2 weeks bullish incentive is very much dependent on breaking and closing over that short medium moving average. Beyond that, we have significant resistances at the trio of the famous congestion levels, 139.99, 140.75 and 141.43. Euro sterling. A reactionary bearish harami yesterday as the market tested and was rejected by the top of the May to date based bear channel, currently 84.62 to 85.51, after just a one try higher on Monday. Now further overhead, we still have the strong resistance from the flatlining medium moving average, currently 85.97, and the slowly descending short medium moving average, currently 85.75. Meanwhile, looking below the 84.70 area, seen as a strong support back in April, has now intruded into the bear channel ahead of the lower bear channel line. Now so far today, a further move lower, away from the upper bear channel line and into mid-channel. US dollar against the Indian rupee. A bearish black crow yesterday, but that's not the full story. Yesterday had a lower open, almost a gapping lower open, with then a fresh attempt at the significant 50% Fibonacci on the February to April move at 74.26. We ended up, importantly, closing below this 50% Fibonacci line and also managing to drop below the July low at 74.22. Now, prior to yesterday, the indecisive spinning tops we'd seen had been indicative of the market's discomfort at pressing down upon this 50% Fibonacci line. But it was not all a bearish story, as the support a little below from the late June congestion between 74.10 to 74.20 managed to hold up the market. However, without this 50% Fibonacci area, that congestion area is not that strong. Overhead, we still have the resistance from the curling over short moving average, currently 74.47, and the rising lower trend line, currently 74.67, and now some distance away, of the recent ascending broadening wedge pattern, as well as the 50% Fibonacci line of the April 2020 to February 2021 move at 74.63. All this has been in the large shadow of the weekly key reversal down 2 weeks ago, and the move late during the week before last, under and away from the recent ascending broadening wedge pattern. Now, initial target X for this pattern is still there in the 74.05 area, whilst the further secondary target X1 would be in the 73.80 area. And so far today, another lower open, and also therefore below the 50% Fibonacci line, and a swift move lower still, halting only at the lesser Fibonacci line at 74.07. Only actually a few ticks away from achieving target X for a pullback up. I suspect that this may not be the only attempt today to try lower. US dollar against the Brazilian real. A bullish piercing line pattern yesterday after the previous session's hanging man pattern, but it comes with issues. Honestly, recently no simple pattern in this currency pair has not come without issues attached. Anyway, the bullish piercing line pattern basically retires the late May to early July bearish Andrews pitchfork. This pitchfork has been testing me by looking like it would not last another day each day in succession for nearly 2 weeks. Then last Friday it gave way, and that's the end of that. Okay, so going back to the hanging man pattern, traditionally these are seen as bearish reversals. However, data indicates that some 6 out of 10 times they are bullish continuation patterns. This time it seems the market followed data rather than tradition. Prices rose up yesterday and breached the lesser Fibonacci congestion at 520.27, 525.67, and the lesser recent Fibonacci line at 526.79. By the time they'd done that, there was no ammunition left to tackle the recent highs in July and the declining medium moving average, currently 529.39. So the market reverted back down and finished up just under the lesser Fibonacci level at 520.27. Now, whilst this still left a bullish piercing line pattern yesterday, it was nevertheless also left a long tongue on top of the market. Not that ideal to have in a bullish pattern. This still leaves open the one question I have been pondering for a number of days, whether this move up has been purely reactionary or if it's the beginning of something else. You see, there are arguments for the late June to date action becoming either a possible double, maybe even a triple top, or a bullish halfway hesitation, and this situation hasn't been settled. This is all in the shadow of the remarkable number of dead crosses we've seen since late May. As I said yesterday, it is already an interesting week here. US dollar against the Mexican peso. Another indecisive pattern yesterday, this time an indecisive spinning top, the third indecisive pattern in a row. However, as for using the word indecisive, well, I explained my thoughts on that yesterday. You see, I've previously explained the market seems to have found some semblance of peace, as it once again was adjacent to the influential gently declining neckline of the February to March head and shoulders top, currently at 1983.23. This neckline seems to be acting as an attractor for the market, and the recent action was all seemingly part of the plan to draw prices towards this neckline, as it had been since April, bar one aberration. Overhead, we still have the flatlining short medium moving average, currently 1997.02, and its recent partner, the short moving average, currently 1996.17. Overall, yesterday's action was another example of what I suppose I must call extensive indecision that we'd seen previously in this market. Indecision that stretches from the fall back to these levels originally seen in mid-April, but which recently started again in late June. Additionally, we're finished just within, again, the April to May based congestion zone between 1985 and 1995. Further down we have the neckline, currently 1958.54, of the late January to mid-May head and shoulders top, acting as support, plus a support band at 1971.68 that's in between. And so far today, a higher open, but then an unsurprising move lower and closer once again to the February to March head and shoulders neckline, though still within yesterday's range. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.